So, let's talk about artificial intelligence. It's absolutely booming, right? You've got companies like Nvidia, Google, Microsoft. Their valuations are just soaring into the trillions. It really feels like we're on the cusp of a whole new technological age. But with every huge boom, there's always that nagging question in the back of your mind. Is this a bubble? And if it is, what's going to happen when it pops?
Okay, let's really get into this, because this isn't the first time we've seen this kind of massive hype. The real question we have to ask is this surge in AI actually building the future? Or are we just watching a familiar and kind of painful pattern play out all over again?
And that's the tension right at the heart of it. I mean, on one hand, you have literal fortunes being made overnight and technology that could genuinely change the world. But on the other hand, you've got central banks, like the Bank of England, coming out and openly warning about stretched valuations and the risk of a, quote, sharp correction. That gets you thinking.
So, to get a handle on where we might be heading, we're going to take a little trip back in time to a moment of just boundless optimism, revolutionary tech, and a stock market that felt like it had nowhere to go but up. Sound familiar?
Yep, you guessed it. We are talking about the dot-com bust. And honestly, the parallels between what happened then and what's happening now, they're getting a little too eerie to just ignore. They give us a really powerful way to think about the risks we're facing today.
Just look at these numbers. The NASDAQ, which is packed with tech stocks, saw a mind-blowing 600% jump in just over 5 years. Money was just pouring into any company that had .com in its name. But when that party ended, man, it ended hard. The whole thing came crashing down, wiping out trillions of dollars in wealth.
And you know what's really fascinating? It's not just the stock charts. Check this out. It's the language. Back in the 90s, everyone was talking about the new paradigm and getting eyeballs on their websites. Today, it's the race to build AGI and the need to hyperscale. The words have changed, sure, but that underlying breathless hype, it feels exactly the same.
So let's play this out. If history is any kind of guide, and this AI boom really is headed for a major correction, what would that actually look like? Well, analysts have sketched out two very different potential futures, and believe me, the gap between them is absolutely huge.
First off, let's be super clear about what we mean by a crash. We are not talking about a little dip here. We're talking a severe, long-lasting drop, like 40 to 70% wiped off the value of AI stocks. That would force the giants, your Googles, your Microsofts, to slam the brakes on spending, and it would almost certainly lead to massive layoffs. Now here is the absolute linchpin, the deciding factor. The severity of a potential crash doesn't just hinge on AI stocks. It all comes down to the US dollar. In one scenario, let's call it Case A, the shock is so massive it actually rattles global confidence in the dollar itself. In the other, Case B, the damage is kind of walled off within the tech sector, and the dollar stays strong as the world's go-to safe place for money.
And this chart just lays out the difference perfectly. If the dollar gets shaky, we're staring down a full-blown US recession, a bear market across the board, and huge economic shocks hitting Europe and Asia. But if the dollar holds steady, it's more of a growth scare. Still painful for tech for sure, but it's a downturn the rest of the world can probably handle. We're talking two completely different worlds.
Okay, so this brings us to the next logical question. When markets get this rattled, when fear really takes over, where does all that money go? Well, throughout history, investors make a flight to safety, and there's one particular asset that has stood the test of time like no other. You really don't have to look any further than the 2008 financial crisis for proof. The S&P 500, a benchmark for the whole stock market, absolutely cratered, down 38%. And gold? It didn't just survive, it thrived, rocketing up by over 25%. This is what they mean by a hedge. When stocks get crushed, gold tends to soar. And don't just think this is some dusty old idea. This is fresh research from this year, 2024. This study puts it pretty bluntly. Gold has reclaimed its throne as the #1 hedging tool, even beating out modern contenders like Bitcoin. Okay, so let's put all the pieces together. We've got our two potential AI crash scenarios, the bad one and the really bad one. And we've got gold as our primary safe haven asset. So the billion-dollar question is, how would gold actually do in each of those two possible futures?
And once again, it all comes back to the dollar. In Case A, where the dollar itself is in trouble, gold's appeal goes through the roof. Why? Because it's a store of value that isn't tied to any one government. Money would just flood into it. Now, in Case B, gold still does pretty well because interest rates would likely fall, but you wouldn't get that same level of, oh my gosh, get me out, systemic panic.
And here is the big payoff for case A. Get ready for this. In a full-blown systemic crisis, where an AI bust actually shakes the US dollar, analysis suggests gold could plausibly surge somewhere between 30 and, get this, 80%. That is a massive, massive flight to safety.
Now let's compare that to case B. In a more orderly, tech-only crash, where the dollar stays strong, gold would still post some solid gains, probably in the 5 to 20% range. Still a great performance, don't get me wrong, but it's a completely different world from that panic-driven surge we just talked about.
So, you might be wondering, what should I be watching for? Well, the data gives us a pretty clear checklist. First, keep an eye on spending cuts from the big tech companies. Then watch for falling orders for AI chips from the manufacturers, the foundries like TSMC. Also, look for signs of stress in tech company debt. But the real alarm bells, the ones that signal that scary case A scenario, that's when you see the US dollar index and US Treasury bond risks start rising at the same time, coupled with a big spike in gold buying from the world's central banks. That's the signal that something bigger is going on.
So, in the end, we're standing at a fork in the road. This incredible explosion in AI could absolutely be the real deal, justifying these sky-high prices and building the economy of tomorrow. Or we could be caught up in a classic hype cycle, just repeating a pattern that has ended badly before. The data shows us the possible scenarios, but the actual path we end up on, well, that story is still being written. What do you think?